I believe that there's going to be a shortage of 1,000-ounce bars, sometime between $35 silver and $50 silver. The reason why is because these fabricators are going to be ordering these bars because they're out. The retail crowd is basically going to overwhelm the inventory levels.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 20th through May 27th, 2024 while supplies last. First, we feature pre-1933 XF $20 gold Liberty coins at just $25 over a 1-ounce spot. We also have backdated silver 1-ounce Philharmonics at $3.15 over spot. And finally, we have the hard-to-find silver half-ounce Canadian polar bears at the very competitive price of just $2.50 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah Johnson with Liberty and Finance. With us today for the first time is Don Durrett from GoldStockData.com. Don, thank you so much for joining us today.
Yeah, thanks for having me on, Elijah. I've watched your show several times in the past.
Well, it's great to have you here on for the first time. And I did want to really discuss, I guess, kind of a broad overview of what we're seeing in the precious metal markets. Obviously, we're seeing silver hold. We're recording this Friday, May 24th. We're seeing gold still hold above that $30 level that it broke out above last week. Your take on silver and then also gold?
I think we probably should start with gold, and then because it broke out first, and then we'll go to silver. So gold broke out in late March, and and at the time, I really didn't think that gold was going to lead here because the stock market has been so strong for, it's going on now, 16, 18 months, quite a run. I thought that, the economy is usually something that slows down gold. They usually don't go together. It's usually if the economy is strong, then gold has trouble. I consider the economy kind of the kryptonite for gold. And so this is a really, this is where people are really confused on what's happening today. So gold broke out March, and then silver followed. It was pretty amazing. It went from like 25 to 32, $7 fairly quickly. And then in China and Shanghai, it went all the way to 36. So China was leading, and China was leading gold as well. It was Shanghai is where they do the futures trading in China. And so you had these really big opens on Sunday night in China starting in like right around March 20th with gold. And then, there's really nothing New York could do but kind of follow that lead by China. And then the same thing happened with silver. China was like over, well over $30. And it stayed there. And, New York couldn't have that huge premium. We actually had the premium up to 17% yesterday, and now it's down to, I think, 12 or 13. So China is still selling silver at $34, over 34. It closed in Friday on China. And so 34 something, 34, 30, 34, 50 versus $30 in the US. So it's about 15%. So we have these big premiums. We have a combination of central bank buying. So the central banks have been buying about 80 tons a month for the last 2 years. It's been pretty staggering, the consistency of the central banks buying gold, about 1,000 tons the last 2 years, and it's been picking up. And so it's a combination of the central banks and China buying gold, and New York doesn't really want to buy gold. They don't want to buy miners, but they've had to. So it's created a kind of a conundrum here on, kind of what's happening. Now, this is leading up to kind of answering your question, what's going on with silver right now. And so this week, we had this big run up, which finally stopped going up and we started going down. So we're down about 6%. So I actually wrote this down. So silver in New York got to 32.40 on May 20th. So 4 days ago. It got to its high of 32.40, and now it's down to 30.30. So it's down about 6.5%. And gold got to 24.50 on the same day, May 20th, and now it's down to 23.32. Now, these are, about 5 to 6% corrections, which it's not very severe, if you will. These are really minor corrections. I think gold is going to correct a lot more than this. This run up to gold at 24.50, I really don't think that's going to hold. Now, it looks like I've been saying, I haven't been really excited about this move. A lot of people are super excited, right? Super bullish, thinking this is it. Now, I do agree that gold, silver, and the miners are basically breaking out of this 3.5-year correction that started in August of 2020. I definitely agree that correction is over. However, we are not in that period yet of kind of blue skies off and running kind of thing. A lot of guys are saying everything's great, we're off and running, but there's still a very, very important factor that's not in play yet. And that factor is the stock market's too strong. In order for gold to have this generational run, this kind of big run that we all kind of want, the only way that that's going to happen. In other words, I chase alpha, I chase free cash flow, so I want big moves. I want to see $3,000 gold, $3,500 gold. Well, you're not going to get there until basically gold outperforms the stock market, and the stock market is underperforming. Last time we had that was from 2001 to 2011. And that's when gold was significantly outperforming gold. So gold went from $250 to $1935. Massive move by gold, right? So it was outperforming the stock market. And the stock market from 2000, 2001, and 2011 had a lot of headwinds because we had a lot of problems in that decade. And so the problems haven't manifested this decade yet. But we've had a lot of problems, and there's a lot of underlying, and this is where it gets real interesting, and it hasn't manifested yet, and I think it will. This is where it gets really, really interesting. It's like, what's going to be the trigger that manifests that risk off trade? That's what I want to see. Without that risk off trade, it's hard to get excited, in my opinion.
That kind of maybe gets to the idea about stagflation, right? When you have a slowing economy and inflation, then that's the best environment for gold. It sounds like what you're saying is you need investors to move out of the stock market and into an alternative asset. Otherwise, you're not really going to see that straight up move in gold. Exactly.
If you look at Newmont, if you look at their chart, it's still underperforming significantly. I mean, we got gold here at $2,300, and Newmont's ASIC's about $1,450, so their free cash flow is right around $1,700, $1,750. So they're $600 margins right now, which are pretty darn solid when you're mining 5 million ounces of gold. So a lot of free cash flow Newmont's throwing off, and if you look at their chart, it's pathetic. I mean, it's trading at $41. They were trading at, they've traded as high as 80 since 2020, and 60 is like kind of that's where they need to get to just to get back. So we're kind of in a retrace. But if you look at their volume on Friday, so all last week gold prices were strong, but nobody on Wall Street was buying Newmont. I mean, the only way Newmont's going to have high volume if Wall Street is buying it, and the volume was pathetic on Friday. It was like, so that just shows you that the sentiment in the miners is still weak, and the reason why it's weak is because we're still in this risk-on trade. Like if you work on Wall Street right now and you go in your boss's office and go, man, we should be buying Newmont, you probably get fired. It's like, go look at NVIDIA, kid. Get out of my office. It's nobody's looking at the miners except for. It's basically a small group of people. It's the outliers that are actually looking at the miners, and they're keeping their voices quiet. They're just looking at them, waiting. It's like, how long can we wait before we buy these things? I mean, people are getting excited. I mean, NVIDIA's at $1,000, and people are super excited about owning that stock, and they have like 3, 4, 5, 6% of their portfolio in NVIDIA, which is probably, over the next 2 years, if we do go into recession, I mean, maybe you might make, if you're lucky, you might break even, you might lose money, you might make 10%. Whereas in Newmont, over the next 2 years, if gold goes to 3,000, which I think it will, it's going to go up 200%, not 10%. It's going to go up 200%. So it's currently at 40, and it's going to go to 120. I mean, and nobody's looking at it. It's like we're kind of in crazy land. And the reason why is because Wall Street controls the narrative, and Wall Street is just talking about their book. They just point at the positive numbers. They look at GDP. So GDP is positive. Unemployment is under 4%. Earnings are, right around 8-9%. So they're growing. The stock market is all-time highs. And the other data they look at, they basically say the next move for rate cuts is down. They're going to cut rates. So they just focus on those four things. That's it. And then they ignore everything else. They might mention it once in a while, but it's on the periphery. It's on the margin. It's not a significant data point. They just bring it up just to kind of not look like idiots, if you will. But they're totally underplaying the risk in this economy, which is super, super high in my opinion. And so that's the reason why this risk on trade is in place. And that's the reason why the miners are being ignored. And at a certain point, we're going to have a pivot. And the pivot is going to be to risk off. And once we go to risk off, that's when that Newmont doubles quickly from 40 to 80, and then from 80 to 120. And then we'll see where it goes from there. If we go all the way to 3,500, then I think Newmont gets to 160 or higher. So, it's amazing that you have this kind of leverage in the bellwether gold producer, and nobody wants to own it.
Now, another interesting aspect of this market is that we're seeing kind of three things going on at the same time. You're seeing a lot of demand in the East. You're seeing a lot of metal being drained from the major exchanges. But on the retail side and the mainstream, they're not really paying attention to this run in gold either. You've mentioned how silver really has to go above 35 or 40 until the retail investor really starts getting engaged in this bull market. Can you expand on that?
Yes, I absolutely believe that the retail market will basically catch fire around $35 silver. And the reason why is in order for silver to get to 35, gold has to basically be doing well. Silver's not going to go to 35 on its own. And so gold's going to be the leader here. So silver is a proxy for silver. And I always say ignore silver. You can ignore the price of silver. You can ignore the fundamentals of silver. You can ignore everything about silver and just focus on gold as far as directional price, because silver is the proxy for gold. And so once gold gets to a certain level and people want to buy it, such as right now, the central banks in China are kind of leading. And so now the West will start to buy it. Well, your average consumer cannot afford gold. They don't have $2,000 to go buy 1 ounce of gold. And you can't really buy less than that because the premiums are too high. You can't, I'm going to collect, a tenth of an ounce coins, right? $200. The premiums are too high. You don't want to do that. If you can't really afford to buy, at least 1 ounce at a time, which is $2,000, you're going to go to silver. And so people that are going to buy silver as a proxy. So once you get kind of this FOMO thing going, where people are going, so the rich people who can afford gold, they're going to be buying gold. Well, trust me, the middle class are people that that can buy $500 to $1,000 a month of precious metals. They're going to buy silver. Those people they don't even know they're going to buy it, which is kind of crazy. I would say the people that end up buying silver over the next 1 or 2 years, a lot of them, it's not even in their head right now. They're not even thinking about it. It's that kind of that herd mentality. So I need to get some precious metals. Okay, well, what do I buy? Well, I can't afford gold, so I'm going to buy silver. Silver's the proxy. So once you get to about 35, that's when that proxy stuff kicks in. And that's when the GSR, the gold silver ratio starts squeezing. So the gold-silver ratio, it squeezed in 2011 all the way to 39. And if you remember, it was a very short-lived period. If you look at the chart, I mean, silver basically went straight up to 50, and then it didn't stay there, and it went back under 40 very quickly. So there's never even really an opportunity for silver to squeeze, and it still squeezed to 39. So the longer, that's that proxy thing. So the longer that silver remains high, the more it squeezes. And the squeeze went all the way down to 18 in 1980. A lot of people think it's going there again, and it could. My target is 30. Which I think is a good number. I think we are going to go somewhere between 30 and 40. And so that's 2x. We're currently, I think we were at 90 really recently. It squeezed from 90 to 75 really fast. That's what the proxy thing does, is the silver it moves from a commodity type of an investment to a hedge type of an investment. So it's kind of it becomes somewhat of a monetary metal. When it does that, it's mined at 10 to 1. So if it's mined at 10 to 1, how can you sell it at 90 to 1? So if it's mined at 10 to 1, once it becomes a quasi monetary metal or a hedge, you're going to get that GSR squeezing. So you get this 2x leverage. And it actually could be better than 2x. I actually think it's about 2.5, because if you go from 90 to 30, that's more than 2, right? So it's about 2.5. That's huge leverage. And you get all that leverage in the silver miners. And I was telling people back in October and November to buy these Mormons. I had these 7 silver miners. Buy those to the bottom, and because you have this huge leverage. I mean, even today, they all print as 5-baggers at $100 silver. Even after this, they've made a bit of a run, but they're still cheap. But we're getting closer and closer. So once you get to 35, you have more and more people running into miners. You have more and more people buying physical silver. I actually think that once you get to 35, it's going to be hard to find 5-ounce and 10-ounce bars, silver bars, because that's what people can afford. A lot of people buy 100-ounce bars. So those might linger a little bit, but 5s and 10s, those things will disappear so quickly. They'll make your head spin. And these websites will be out really fast. All of your coin dealers will be out. They call it unobtainium, and that's what will happen. And so the last one is going to be APMEX, which has the largest inventory. Once they're out of 5 and 10-ounce bars, it's going to be really fascinating. And that's the point where silver, because of the lack of physical. Usually a paper market kind of controls the price, but once those 5 and 10-ounce bars are gone, I think that the physical will get some upward pressure. It's my expectations. I'm actually expecting a shortage. So 5 and 10-ounce bars are made from 1,000-ounce bars. 1,000-ounce bars, that's what all the fabricator buys. When you look at a pallet of silver, those are 1,000-ounce bars. They're not exactly 1,000-ounce bars, because it's too difficult to make exact 1,000-ounce. So they're plus or minus about 3 ounces, maybe 10 ounces of 1,000. And those big, huge things, they weigh 75 pounds. They're heavy, really heavy. So those are what they make the 5-ounce and 10-ounce bars from. I believe that there's going to be a shortage of 1,000-ounce bars, sometime between $35 silver and $50 silver. Depending on how fast silver goes up. But somewhere around there, I think the reason why is because these fabricators are going to be ordering these bars because they're out. And they're like, I got to the retail crowd is basically going to overwhelm the inventory levels. So about 70% of your silver is used by fabricators and 30% by investors. And last year, it was actually higher than 30% for investors. And I think it might be higher this year. So last year we had I think it was over 200 million ounce deficit. It was 170 million to 200 million ounce deficit. So that had to come out of above ground inventory. Well, this year the deficit is higher. This year it's above 200. And so where's that coming from? And so those are all 1,000-ounce bars. Once you're out, once the inventory is out. Now, one of the things we're seeing finally in this question here is we're seeing the inventories drop at the ETF level. Well, you can actually take delivery at SLV if you're a participant, but you have to take 32,000 ounces. You can't take, people like us can't do it. But it's basically a ton. You can take 1 ton, you can sell a ton and take delivery. And we're seeing the inventory levels drop while silver goes up. And I think that they're using the ETFs as inventory.
And the ETFs and the major exchanges that we're seeing that drawdown happen on, those are the 1,000-ounce bars, right? So if we see this, we've seen it here. We sell precious metals, obviously, with Miles Franklin, and we saw it back during the banking crisis, silver squeeze. We've seen this where retail inventory just gets wiped out, right? And so those 10-ounce, 10-ounce bars, the 1-ounce coins and rounds just get wiped out. And you're saying even the 1,000-ounce bars this time could become scarce. Is that partially also because we're already seeing a drawdown of them on the major exchanges and ETFs?
Yeah, I'll give you, a perfect reason why I think I'm right. I actually predicted this back when I wrote my book in 2010, that it's inevitable that basically we run out of 1,000-ounce bars because so much of silver is used for fabrication, 70% plus. Silver's used, you can't make anything electronic without silver. You can't make a vehicle without silver. And solar panels use a ton of it. And then the windmills use a ton of it, and electric cars. So it's just, silver's needed, if you will. It's needed for all these fabricators. So then it's the investors that go in and basically cause the problem. The investors, again, when it's a proxy, the investors basically, suddenly they want it, and they call it the silver squeeze. But here's the point I was going to make about how I kind of can show you how it's happening. In 2021, the Shanghai Exchange had 3,000 tons of silver. In April, over 100 tons left the exchange. Today, so it's in April 1st, it was over 900. It started. So it went from 3,000 tons in 2021. And then April 1st, it was over 900 tons. And now we're in May. It's now below 800. So they have less than 800 tons, and it's been dropping over 3 years, and it's dropping at a faster pace. So if they drop 50 tons a month, they're going to have a problem in 6 months. So they already have one. And so where are they going to get the silver to replace? Where are they going to go and 500 tons? Are they going to still, are they going to rob Peter to pay Paul kind of thing? Are they going to go steal it from another exchange or, because there's no inventory, because they can't get it from producers. Good luck with that. All that silver is already taken. There's a voice for it already. So they got to go. How are these places going to resupply themselves? So COMEX has actually done really well. I found it really interesting. If you look at the inventory at COMEX, it really hasn't shrunk very much. But I think that's going to happen soon, if you will. Once these shortages, once silver gets above 35, I think you're going to see the COMEX start losing 50 tons, 100 tons a month as well, just like Shanghai. The other thing I'll leave on this inventory thing is there's only 3 places where you can basically find inventory: the Shanghai and COMEX, and then the LBMA in London. Those are really the only 3 other than the ETFs. But the ETFs, again, those can only be, you can only take delivery if you're a participant, and you have to take 1 ton at a time. So there's not a lot of inventory out there.
So what happens when, as you mentioned, silver becomes unobtainium? Obviously, the price goes up, but do you actually see maybe problems for industry developing? What are the ramifications of that if physical supply just completely dries up?
Yeah, it gets really interesting once you get above $50 silver. The risk for investors starts increasing. A lot of people don't realize these added risks. The first thing that could easily happen is the G7 could basically recognize that we have inventory problems on silver, and they could call silver a strategic metal. And I think that's what's going to happen. but I don't know when. But my guess is somewhere between around $75 silver, somewhere in there. I don't think it'll happen 50, because it's going to take some time for all that stuff to unfold. But I think somewhere around 75, so our silver miners start adding a lot of risk, because we could see, if they do call that a strategic metal, we could see silver drop like $20 in a single day. And if that happened, your miners could drop, all of them, all your silver miners could drop 25% or more in a single day. That could happen if they made that type of announcement. And the other thing that would be ugly is if it was just a rumor. So if there's a rumor that they were going to call it a strategic metal, then that would put headwinds on our stocks, and they would stop going up, and they might, that would be kind of ugly, right? It's like, because at $70 silver, a lot of these stocks are going to have really big multiples. We're going to see stocks that have multiples in the 20s that normally you would think they'd be, 10 to 15. And so they're going to be they're going to be perceived to be overvalued. And so then if they're perceived to be overvalued, then the rumors come in, they're going to make it a strategic metal, then they could get sold off just on the multiple basis alone. And so that's a big risk we have to consider. I mean, you could be, especially people that are getting in late, and then, their profits could disappear overnight. But so I'm going to sell to the top for this, because I see this risk. I see this possibility of silver basically if you have shortages, I think they will call it a strategic metal. Just think of all the big companies that need silver, right? GM, Toyota, Volkswagen, Apple. I mean, these are big companies, right? And then any company that makes computers, NVIDIA. These companies go and they go, look, we can't find any silver. Do you really think that the government's not going to listen to these guys? Of course they are. So if there's any shortages at all, I got to believe they'll call it a strategic metal. And I think that's coming. Now, a lot of people say, Don, if they do that, they can't still stop the price from silver going higher. And, maybe they have a good argument there at a certain point. Yeah, silver drops initially, but that inventory problem is kind of still there. And can they really resolve it by basically ending? I haven't even talked to, the ramifications that they call it a strategic metal. So the first thing the ramifications is they would basically outlaw ETFs. So the ETFs have about $1 billion of silver ounces. So that would immediately go on the market. So that's good. You dump 1 billion ounces so that's a lot of excess silver. I mean, right now the demand is about 1.2 billion. So if you dumped 1 billion, that would get you, probably 3 years of inventory. And so I think it could really put a big kibosh on the silver miners at a certain point. But over time, silver they would use up. Once that's done, once they work through that inventory, then the price would start going back up again. It's something to think about, if you will. And I do think about it. So, I like I said, right around $75 silver, I expect those rumors to start spreading.
It seems like there's a lot of wild cards out there. We don't know what the U.S. government would do. And I think the case you've made for calling it a strategic metal is quite convincing. Do you anticipate people obviously are always wondering about confiscation, right? Nationalization of mines. Are those also possible consequences of calling it a strategic metal?
No, I think the nationalization of mines is way overblown. It's very difficult to nationalize mines because what you're going to do is you're basically going to damage the industry. So, Venezuela did it, and look it's a total mess, right? Bolivia tried to do it and they backed off. I mean, it just doesn't work. A lot of people think that maybe Mali right now might nationalize. It just doesn't make sense for countries to nationalize mines because you're going to reduce investment. People are like, well, I'm not going to invest in that country. You're a company. I'm not going to go and do exploration there. So it's a net loss for the companies. However, The risk is once silver gets to $50, there's two things that are going to happen. Number one, they're going to raise their taxes and royalties on silver mines and probably gold mines too. So precious metals, gold and silver, they'll raise their royalties and taxes. But hopefully they won't do it in a severe way that will restrict, because we saw this in Ecuador. When they go too high, when they raise taxes too high, everybody leaves. So they can only raise taxes and royalties so much. Like, Mexico, probably only going to raise taxes probably 10%. But just enough do they get a big chunk of the money, but not enough to kind of stop investors. So I only see, the royalties going up, 5-10%. I don't see when Ecuador, they basically bumped it up like 50%. I mean, you can't do that. And I think countries have learned that lesson. The big risk, I think, is countries demanding ownership, small ownership. They call it free carried. Liberia is a good example. In that country, they get 10% free carried. So free carried means they don't have to pay a penny and they get 10% of the revenue. So that's what we're going to see. We're going to see a lot of countries that will go and say, look, and some of them they'll grandfather in. They'll basically say, existing mines, we're not going to go and make you sell 10% of your company. But kind of all new companies, all new mines, it's like that mine, we get 10%. We're going to see a lot of that. And so we don't know how much that's going to impact the mining sector per se. But I think as far as gold miners go, I'm bullish on gold miners. I don't think there's going to be a problem with gold miners, because you're not going to get any shortages in gold. And I don't think that these countries are going to tax people into the ground, take the free carry to an extreme. They're just going to take their pound of flesh, but the miners are going to keep making money. So I'm very bullish to gold miners. I'm not going to sell it. For instance, I don't have any problems waiting to sell my gold miners. A lot of them, I'm going to wait until gold gets to 3,500 before I sell even a single share. I will sell some from 27 to 3,000 for stocks that are up a lot. The stocks that are up a lot, I'll start taking profits around 2,700, but not a lot. I'll take a lot more profits at 3,000. But a lot of these companies, I won't even touch them until we get to 3,500 with gold, because I'm not worried about nationalization, taxes, and that stuff. Because again, I don't think they're going to impact or just injure the sector significantly. Now, silver is a whole different question. We talked about that. The risk on silver is huge. Absolutely massive. I mean, you could have 100% gain in a stock, wake up the next morning and it's down to 50. That's going to be a big, punch to the stomach kind of thing. So we're going to have to be careful with silver miners.
It will be interesting to see. Now, moving to gold here, I know there are some potential catalysts for higher gold prices. Obviously, we've already been seeing a lot of demand from Asia, central banks buying gold. Your take also on the BRICS, right? Because Russia and China have been buying gold, and there's been talk about a new BRICS currency. Do you think that could actually be developed, and do you think gold could be a part of that at all?
I think the chances of a BRICS currency is really high. I would put it at least at 70%, and maybe 80, 70, 80. Now, the reason why I think a lot of people think it's a 100% chance that they're going to do it. But the problem with a BRICS currency is that it doesn't help all of them. It actually penalizes the importers. It's like switching from the dollar, which penalizes importers with that bad currencies, to now this currency is going to basically replace the dollar. And I'll give you a perfect example: is that India currently doesn't export a lot, and so they import. So what are they going to have to do? They're going to have to sell the rupee to buy this BRICS currency. So whenever they do that, the BRICS currency, they're selling it. So it's going to come under pressure. It's going to lose value. And if the BRICS currency, and I think it'll actually be a fairly strong currency. So if the BRICS currency is a fairly strong currency, India is screwed, because the rupee it has to compete against that, just like it has to compete against the dollar. So they're like, they don't want any part of this thing. That's why I only put it at 70, 80%, because India, they might have kind of veto power. And they might be able to convince some of these other BRICS countries that, look, you're getting screwed, we're getting screwed, you're getting screwed too. What India wants to do, they want to trade in rupees, right? They're like, okay, we'll buy, we're going to buy your Russian oil in rupees. That's what they want to do. But, is it that conceivable? Now, China and Russia are net exporters. They don't have to buy any of these BRICS currencies. They're going to get paid in them. So it's beautiful for them, right? I mean, it's like a win-win for China and Russia. So if you're an exporter, you absolutely love it. It's like you're an exporter and you have this strong currency. It's like, wow, that's great, right? So it's problematic on implementation. It sounds good in theory, but in practice, it's not so simple, because your country is giving up its sovereignty in many respects. You better export something. Now, South Africa, they don't export, they import. So that they might be negative too. They might be kind of in India's camp. Brazil exports a lot. They export food, they export oil. So Brazil's like, yeah, we're good. So Brazil, Russia, and China are like, yeah, what do we sign? We're up, I'm good. But India and South Africa, not so much. Nigeria is now, they're involved. They're exporters. So they get some of these oil exporters involved, Saudi Arabia, the Middle East, Iran. The exporters are like, sure, let's do it. So if this is a majority type of a situation where the majority gets to decide, then I think it goes through. But if you remember, when they were in discussions in South Africa last year, it wasn't a majority rule. It was 100% across the board. So India basically vetoed any discussion. If you remember, they barely talked about it. Do you remember? They barely talked about the BRICS currency. And why? Because it wasn't a majority rule. It was a majority rule. They're like, yeah, we're talking about it. We don't care what you have to say. But the BRICS originally were countries, 5 equal countries. It was never a democracy. It was always equal partner, and each partner has to agree kind of thing. So now they're trying to expand this thing to like 25 countries. And I think it's going to go to 50 plus. So at a certain point, it's probably going to be a majority rule kind of thing. But when it's 5 countries, India had a veto. Now, does India still have their veto? We're going to find out in October. If they still have their veto, then they won't even talk very much about it, the BRICS currency. But if India is basically backed into a corner where they have to take it, then they'll talk about it. So it's going to be really interesting. Now, the one thing we haven't discussed is, how does that impact gold? If they create a BRICS currency, I guarantee you it benefits gold, because gold is going to be part of that currency. Absolutely. Because gold is something that China and Russia have been accumulating, and they want that currency to be backed by gold. They want to be backed by gold for several reasons. But the number one reason is stability of the currency. They saw what happened to the U.S. dollar. The U.S. dollar got deflated into the ground. They don't want this BRICS currency to get deflated into the ground either. So they want gold to basically be the substantial holding. I wouldn't be surprised if gold is at least 25% of it, maybe even 50. But 25 to 50 is my expectation, and the rest is either going to be currencies or currencies and commodities. I think it's just going to be gold and currencies. That would make sense. The one thing that I'm shocked that they're not doing, because, and I think people are going to find this fascinating, what I'm about to say, is if you go back and you look at what Facebook was trying to accomplish with their cryptocurrency, now I can't think of the name. Maybe I'll remember it when I'm thinking through this. So Zuckerberg, he basically said, I'm going to create my own cryptocurrency, and it's going to be based on all of the currencies around the world. So they balance each other out. So basically it becomes the value of all the currencies around the world. It was Libra. It was called Libra. And so the Libra coin is absolutely a brilliant idea, because what you can do with the Libra, let's say you use 25 currencies, right? And then you rebalance those currencies on a daily basis, the ones that go up and the ones that go down. So it's basically a stable coin backed by currencies. So it's not backed by gold, but it's backed by currencies, but it becomes basically the best currency in the world. Now, why wouldn't they use that idea? And then, they don't have to worry about gold. They don't have to worry, commodities. They don't have to worry about gold going up, gold going down. Currencies are based on GDP. So global GDP is basically your baseline. And some countries are going to do better than others, and so they get a better weighting. But I just thought that Libra is a brilliant idea. Well, the banks and the U.S. government, they basically, as soon as they heard about what he wanted to do, they basically said, no, you're not. You do that, we'll find the hell out of you. You're not doing that. Just take that idea and table it. They kiboshed it. They said, no, you're not. And they could do that because Facebook's a company and the U.S. government has regulatory power over them. Well, guess what? A government, if they wanted to create a Libra coin, nobody can stop them. Any government can do this. I've been waiting for a government. We just had Zimbabwe create the ZIG, the Zimbabwe gold certificate. So that's kind of a first shot under the bow kind of thing. I'm waiting for a country to create the Libra coin, because the Libra coin is absolutely a beautiful idea that will work, and you tokenize it. So you're basically creating a stable coin that's backed 100% by global currencies. It's the thing of beauty. Why isn't somebody doing this? And so, the BRICS are so caught up in gold, using gold to back their currency. They're not even thinking about this. This isn't even on the table. They just keep talking about gold, gold, gold. So I think the BRICS will be backed by gold, but I do think that some country is going to create a Libra coin. They're going to basically have one of the best currencies in the world. So they basically, Argentina would be an ideal place, right? The Argentina peso is a piece of junk. They didn't want to go to dollar. They talked about it, but they're not. They're staying with the peso. Why don't they ditch the peso and create a Libra coin? The other win-win is the Libra coin's digital, so it basically becomes a CBDC where they can track transactions, which they want a CBDC. Well, if you create a CBDC that's basically what I've just explained is basically perfect currency, then people accept it, and voila, you basically have a way to monitor transactions. So I expect I don't know why anybody hasn't been talking about this Libra coin. Like I said, I think Zuckerberg's idea was brilliant. I don't particularly like Zuckerberg. I don't like Facebook. I think on the whole, it's been a net negative to society, but we'll leave that there.
No, yeah, I mean, agreed on that point there, definitely. Now, when it comes to this Libra type kind of coin, it's interesting because currencies around the world the value is thought to be based on kind of the faith and credit of that country and the strength of their military and all of that, their influence. But this is not like that at all. So I think that's very interesting. It's like a completely different kind of currency altogether.
Yeah, well, the thing that's beautiful about it is it's basically self-adjusting because all these currencies are floating. And so you can self-adjust it. You can self-adjust it daily. You can self-adjust it weekly, monthly, whatever you wanted to self-adjust it. But it's based on exactly what you said, the combination of global GDP. And it's a perfect idea.
And that would probably be a threat, kind of a threat to the US dollar, obviously, but one that would be coming out of left field if any country were to establish that, or the BRICS were to.
Yeah. The thing that's beautiful about it is there was a book that Irving, it's called The Mandibles by Lionel Shriver. And in that book, the thing that's fascinating about the book is she had never written, she had won book awards. She was a fiction writer writing stories, and she'd never written anything on economics, anything on money. And she wrote this beautiful book about how the US dollar basically collapses. It's called The Mandibles. It's a beautiful read. I don't read fiction, but somebody told me, you got to read this book, and I really enjoyed it. And basically what she says is that the US dollar gets replaced by something called the Bancor. And the Bancor is basically the Libra coin. It's basically a stable currency that's a combination of other currencies. They basically take it's not backed by gold, it's basically just a combination of other currencies. It's basically the same type of idea as the Libra coin. And that's what she said, that's what destroys the dollar. So what happens in that book, I'm going to ruin it for you, but what the heck? In that book, the fear that what destroys the US dollar is our bonds. So our bonds, we keep inflating and we're paying people back with deflating dollars. She wrote this book in like 2016. So we're paying them back in deflating dollars, and the world basically gangs up us and says, we don't want any more of your dollars. We want they created the Bancor, and they said, you got to pay us in Bancors. So you owe us $2 trillion in your bonds, or you owe us $2 trillion in US dollars. You have to pay us in Bancors. So you can't pay us in deflating currency. I mean, it's a brilliant idea. I mean, that's exactly what's going to happen, by the way, is either the world is going to basically say, you either pay us back, we don't want your stinking dollars anymore. We're holding your bonds. You pay us back in gold, or you pay us back in, something else. We don't want any more of your dollars. Forget about paying us a principal back in dollars or paying interest in dollars. We don't want them. We want real money, because you're basically just printing those. You're printing and you're deflating us, and we're getting back pennies on our dollars. And interesting, it's really good that we talked about this, because it really brings us back to gold. That is the reason why gold's going up right now. Luke Gromen makes this really good point that if you buy oil with dollars, you don't get as much oil as you get if you buy oil with gold. So the rest of the world is basically going, we're just not getting any bang for a buck for these dollars. So we buy these dollars, we hold them, they go down in value. We buy them in gold, gold goes up in value. We're getting much more bang for the buck in gold than we are in dollars. And so these countries, they're buying commodities in dollars because most international trades in dollars, and they're getting the short end of the stick. And that's one of the reasons gold's going up here. Gold's going up here because more people are going, I want gold so I can buy commodities. So there's more demand for gold. So there's demand for gold from the central banks because they know that there's this change coming. And if there's this change coming, then I have all these reserves in dollars, and those dollars are going to be worth nothing. I better get some gold. So you got that going on. And then you have countries that say, okay, I need to buy commodities. Well, my dollars aren't going as far as they need to go, and they're getting cheaper and cheaper and cheaper. I mean, they say the inflation is like 2.5%, 3%. Well, if you go back and you look at how they used to monitor inflation, it's higher, right? They've changed the way that they do this. And so inflation is much, much higher than they tell us, if you will. So the cost of living is going up higher than they say. The net loss, if you will, to holding U.S. treasuries internationally is higher than they say. And that's why gold's going up. And that's why I think right now we've entered a gold bull market that will last 2 to 3 years because of everything I've just explained.
Well, it will be very interesting to continue to track this. If our viewers are interested in learning more, they can go to GoldStockData.com. Can you share with us what they'll find there and any last thoughts you had?
So if they own any gold or silver mining stocks, then they want to be a subscriber to my website. It's basically, and the reason why is because I've been doing this for 20 years, but my website has been up about 12 years. My database has 850 gold and silver miners, and I rate every single one. So they can cross-check what they think about the stock, but I give it a rating. I give it an upside rating, a downside rating, a quality rating. Then I also value it based on future gold prices. So you see what the upside is. Plus I give a description of the company, my own description. So, and then you can search the database. There's all kinds of searches. So if you own any gold and silver miners, then you definitely want to check me out.
Fantastic. Well, Don, Durrett, we really appreciate your time and insights today. It'd be great to have you back on sometime soon to really get a follow-up interview on everything that we're seeing, because there's so many different moving parts here, but we really appreciate your time, and God bless.
maybe September 1st. I think that would be probably a good time to go over all this stuff, and we can, it'll be still fresh in your mind, and we can review what's happened from now until September, because I just have a feeling that the economy is going to get basically hit in the face here soon, because the underlying weaknesses, like the rates basically catching up to us, if you will. And I think they are catching up to us. So the Fed is going to have to make this perfect, landing, if you will, of lowering rates right when the economy is slowing and preventing the economy from going lower. So the economy is slowly going to go down, down, down. And then suddenly the Fed is going, okay, we cut rates, and then suddenly everything's, great again. And I'm basically saying that is fantasy, that the odds of that are very, very low. Historically, when the Fed cuts rates, they usually cut rates because something's bad is happening. And I think that is exactly what we're going to see here as well. So we'll end it on that.
Fantastic. Well, Don, thank you so much for your time, and God bless.
Thanks, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for May 20th through May 27th, 2024 while supplies last. First, we feature pre-1933 XF $20 gold Liberty coins at just $25 over a 1-ounce spot. We also have backdated silver 1-ounce Philharmonics at $3.15 over spot. And finally, we have the hard-to-find silver half-ounce Canadian polar bears at the very competitive price of just $2.50 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.